Hi there. In this video, we explain whether cash basis or accruals accounting works better for UK landlords earning under £150,000. I'm Maz from MTA.
Imagine getting a tax bill for rent your tenant hasn't even paid yet. Now, imagine the opposite, losing out on thousands of pounds in legal tax deductions simply because you checked the wrong box on your return. If you're a UK landlord bringing in under £150,000 a year, HMRC automatically places you on the system called the cash basis of accounting. It's the default. But accepting the default setting on your phone is one thing. Doing it with your property portfolio is another. What's easy isn't always what's financially optimal. Look at this timeline. In April 2026, Making Tax Digital, or MTD, for income tax becomes mandatory if your gross qualifying income is over £50,000. The accounting method you lock in today will dictate exactly how painful and how time-consuming those new mandatory quarterly tax updates will be. That's why we've partnered with My Tax Accountant to guide you through this transition and help you make the right choice for your portfolio. Coasting on your current tax settings into 2026 is a risk. It guarantees either severe administrative headaches or leaving serious money on the table. Let's start with the hard rules. HMRC restricts the cash basis to unincorporated landlords making under £150,000. Here is a common trap. The $150,000 limit is based strictly on your gross receipts. It doesn't matter if your net profit is only £20,000 after paying the mortgage and repair bills. If your top-line rent crosses the limit, the cash basis is off the table. Cross that gross threshold or operate your portfolio as a limited company or LLP, and you are legally forced to use the accruals method. You have to calculate your gross revenue first. You cannot map out an accounting strategy if you don't know what you legally qualify for. Under the cash basis, you only record income when cash physically hits your bank account, and expenses when you pay them. If a tenant owes rent in March but pays in May, that income crosses the April 5th boundary and counts toward your next tax year. The main benefit here is MTD 2026 simplicity. Automated bank feeds connect directly to your software and practically build your quarterly tax updates for you. But that simplicity comes with drawbacks. Your year-to-year profit can swing wildly. A tenant paying late or handing you 6 months of rent in advance skews your taxable income without warning. It also comes with strict limits on loss relief. Property losses under the cash basis cannot be offset sideways against a PAY day job salary. Furthermore, if you rely on unsecured commercial loans, the cash basis caps your interest deductions at a strict £500 a year. The cash basis is a blunt instrument. You are trading strategic tax flexibility for extreme administrative peace of mind. For the accruals basis, or GAAP, income is recorded the moment it is earned, and expenses when invoiced, regardless of cash movement. You can owe tax on rent a tenant hasn't paid yet, even while your bank account sits at zero. Heading into MTD in 2026, this creates an administrative headache. It requires manual quarterly adjustments to track every debtor and creditor. So why use it? Because it gives you full access to sideways loss relief. If your portfolio takes a heavy loss in its early years, you can apply that loss against your other income to generate a tax refund. It also provides completely uncapped deductions for commercial, non-mortgage interest. Accruals requires meticulous, traditional bookkeeping. But for landlords with heavy losses or high unsecured debt, it acts as a vital financial shield. This graphic represents a specific legal trap governing properties owned 50-50 by spouses or civil partners. The law mandates that both individuals must use the exact same accounting basis for their tax returns. If one partner opts for accruals to chase a specific tax relief, the other partner is legally dragged into that exact same heavy administrative burden. Tax planning for joint owners cannot be an isolated decision. It requires a unified household strategy. The correct method depends entirely on your current phase of portfolio growth. Take co-file 1, the steady earner. They have 1 to 3 properties, stable standing order tenants, and no major renovations planned. As you can see on this flowchart, the steady earner belongs on the cash basis. The ease of MTD bank feed compliance in 2026 vastly outweighs any minor tax tweaks. Now consider Profile 2, the heavy renovator. They just bought a fixer-upper and expect a massive net loss this tax year. The heavy renovator should choose accruals. This ensures they can carry those losses sideways against their other income. Finally, we have Profile 3, the highly leveraged landlord. They rely heavily on unsecured commercial loans for business operations. They also belong on accruals, specifically to bypass the strict £500 interest deduction cap. The optimal accounting method is not a permanent identity. It is a strategic tool that must match the exact operational reality of your portfolio. While you are allowed to switch between these methods, doing it improperly is dangerous. HMRC requires complex transitional adjustments when you switch to ensure income isn't accidentally taxed twice or missed entirely. You should never attempt to switch mid-year, and we strongly suggest avoiding the process without a tax professional reviewing the numbers. MTD 2026 is approaching fast. If your combined gross income is over £50,000, the time to prepare your digital records is now, before the penalty points begin. My tax accountant can model the exact financial outcomes for your specific portfolio and handle the entire MTD transition for you. Subscribe to the channel for more definitive financial guides. This video is for educational purposes. UK tax laws are subject to change, and you must consult professionals like My Tax Accountant before making financial decisions.